have a small slide on basically how is industry changing now, or how you can also adapt to it basically. Okay, so I'll just go to the next slide. Okay. So these are the industry participants when you look at wealth management as an industry. So in the front end, which is facing the customer basically, you have banks. So any bank which you take, HDFC Bank, ICICI Bank, they will have a retail division to start with. They will do all the small transactions. Then you go one layer up, you will have a wealth management division. Then you go one layer more up, then you have this private banking division. Okay, so each division is classified like that because of the size of the assets they manage. Okay, so I'll just stick with private banking, which is the largest guys in the banks, or if you consider HDFC Bank or ICICI Bank, private banking division is the division which handles the largest amount of money. For a consideration, we will say, okay, 2 crores and above, or 2.5 crores and above, or let's say 5 crores and above, private banks start managing money of an individual or a corporate for whatever reasons. Okay. So this is the size they will start with. So below that, it will go to a wealth management division or a retail bank. This is one sort of front-ending the entire industry. Like the banks have this sort of divisions to talk to customers and bringing the money to manage them. Now, who else is there? Now, banks definitely not only manage money, they will do other things. They will sell forex, they will sell insurance, they will sell home loans, they will sell demat accounts, they'll sell everything basically, credit cards and all those things. Now, if you move a little away from banks, then you've got wealth advisors, pure advisors. They don't do anything else. What I said now, they only manage money. Okay. So you will see a umpteen number of wealth advisors in the country. Wealth advisors also a couple of types. One is a pure advisory model is there. What happens in a pure advisory model is that client pays the wealth advisor. Okay. The other model is, we call it distribution model in the wealth advisory space or wealth distribution space. So what happens in distribution model is that the client do not pay the firm which manages the money. The firm gets compensated by the product manufacturers which get sold to the client. So I'll tell you who all are the product manufacturers, what are the products they manufacture and how they make money. So the wealth advisors are itself classified into 2 sets. One is a pure advisory where client pays the advisory firm, where they don't get compensated by any product manufacturer. Second is a distribution type of model where the distribution firm gets compensated by manufacturer of the product. When I say product manufacturer, don't think it's a factory or something. It's not a factory or something. I'll tell you how it works. Okay. Third, or the last set, or the top guys who manage money for HNIs, UHNIs. So HNIs are high net worth individuals, UHNIs are high net worth individuals. So those guys who manage money in India. Okay. So how do you define HNIs? So there is no definite answer for it. But let's say $1 million. Okay. So today $1 million is roughly about 8 crores and above, right? So above that only, basically family offices will start looking at the client. Okay. So family offices, what is that different from a wealth advisor? What is different from a bank basically? So what happens is that, like I said, wealth advisor, when they manage money, they only look at the money, how it can be allocated to different products and things like that. Now family offices, it will take one step ahead, 2 step ahead, or 3 step ahead. Like I said, if I go back to the introduction about interest family office, you see these services across. You see estate planning, you see corporate trusteeship, you see CFO services, you see property management, you see philanthropic services, anything. Basically, they get into entire life cycle of a client. Basically, if a client onboards into a family office, if it's a pure family office client, basically the client do not even think about his most of the affairs except for his job. So the only thing he has to focus is his job, and rest everything in terms of families. So that's why it is called family office. Entire family affairs is taken care by family offices. So that's where the differentiation comes between banks, wealth advisors, and family offices. These are the guys who front-end wealth management in India. Okay, so like mentioned in the initial stage of the call, any questions you can park it for the later part of the session. I'll address it as much as I can. Okay, so this is the front layer. Now coming back to middle layer. So middle layer is, I've been telling the product manufacturers. So for this front layer to sort of go to customer and say, hey, this is what I'm going to put into your portfolio. This product is what I'm going to put into portfolio. This suits your portfolio really well. Okay, so who manufactures this product? Who builds this product? Who introduces this product into the market? So mutual funds are one, guys, right? Everybody would have heard about mutual funds, or anybody would have heard about SIPs. Everybody keep talking about SIPs, right? So basically systematic investment plans. So generally the SIPs happen into your mutual fund. So mutual fund is one set of guys who manufactures this product, which is sort of front-ended by the other three guys, or broadly these three guys, which is written above. Now, after mutual funds, somebody else comes, which is PMS. PMS is portfolio management service. There are very specific or very specialist PMS managers in the country. I'm not sure if you all are researching well. You would have definitely heard about Saurav Mukherjee. The Saurav Mukherjee runs Massless. So Massless is a PMS. So a lot of other guys also do it. I'm not biased towards any PMS manager, but I just give you an example. So Motilal does this. You have White Oak does this. Interest Family Office has our own PMS. Then we have ASK Advisors who has a PMS. So what is different from a mutual fund and a PMS? A way of building a portfolio. So typically, if you look at all of the mutual funds, you will find 50 to 60 stocks, or roughly most of the mutual fund will have more than 30 stocks basically. If you look at PMS is more concentrated. It's not so much diversified. PMS will have roughly about 20-25 stocks. So PMS, where the fund manager will be so much clarity about what he is going to. I'm not saying mutual funds, the fund manager will not have clarity, but I'm saying it's more concentrated. He runs behind a team. So maybe he runs behind a team basically. So PMS runs like that basically. Now, and one more thing is that mutual funds do not have, I would say, any sort of lower limit to enter basically for an investor to enter. So sometimes many mutual funds I have seen even 500 rupees is enough for an investor to participate in that particular mutual fund, right? And what happens when it goes to PMS? PMS, the minimum investment size is 50 lakhs. So not everybody can participate in a PMS. Okay, so let's move to AIF. So AIF is what? Alternative Investment Fund. So what happens when you move to AIF? The size of initial investment moves again higher. So AIF roughly will have, the investor should have about 1 crore minimum investment to an AIF. So AIF also has different categories, Cat 1, Cat 2, Cat 3. These are more technical things, so I'm not getting into that. But generally, the wealth management as industry follow an AIF route if they have to play a particular strategy. Okay, so I'm not getting into technicalities, but AIF, for your understanding, AIF is a separate product, and there are only AIF players who only do AIFs, and the minimum investment for an investor to come in is 1 crore. So then you have your PEs, your private equity players, your VCs. Your venture VCs can be a private, I mean, they get into only equity side or debt side. So venture capitalists can be an equity guy or a debt guy. So I hope you have done some research on this. Or else maybe once the presentation is over, you can just pick up from this presentation and just Google it. So these are two different terms which are very prevalent today. The venture capitalists, when I say equity guys, if you would have heard about Sequoia, if you would have heard about your SAFE, today SAFE is Elevation Capital. So you have umpteen number of guys who are in the equity space who sort of fund these startups. So those are VCs in the equity space. So there are guys who are only funding in the debt side, so or fixed income side. Like a startup needs a small bridge loan, a loan for a 1 year time or 2 year time. So then venture capital debt guy come in. Um, so if you have heard about a company called, so there are, I just missed that name now. However, I'm saying what happens today. What these guys are looking at is, let's say startup is generating a good amount of revenue. So the other guy on the other side basically says, okay, hey, you are generating a good amount of revenue. I will sort of take the repayment from that revenue. I will take the revenue what you earn from your business. I'll take the repayment from that revenue. You accept my loan. Basically, obviously, the startup would have gone and approached this VC, or the VC would have approached saying that, hey, we're ready to fund you, or this guys would have asked it, can you fund us? So when venture capital, when I say fixed income, this is a loan which gets funded and they will repay because of the revenue inflow which they have. Because majority of these startups would have not become profitable by the time when they ask for a VC debt or a VC equity. So now, initially when I said I have also been with an NBFC, you would be thinking why an NBFC fits into a debt management. So what happens is that these NBFCs, when they want to raise money, they will issue NCDs. When I say NCDs, non-convertible debentures. I'll just shorten it. We'll call it debenture. Okay. So NBFCs issues debentures to the public investors, and the investors subscribe to these debentures. So these are fixed income debentures. When I'm talking about, there could be convertible debentures also. When I say convertible debentures, the fixed income investment which they have made, the investor has made, after some time it could be converted to the share, basically the equity of the company also. So NBFCs issue debentures. So when I work with an NBFC, what I used to do is these debentures. We used to do multiple things. So not only NBFCs can only. I'm not saying NBFCs can only issue debentures. NBFCs can also issue. They can issue multiple products and raise money from the market. It could be a securitized debt. I'm not getting into that technicality. So I'll stick to debenture again. So when a debenture is issued, how it works is that, let's say the NBFC want to raise 10 crores of money. Okay, so they will issue debentures of this NBFC. So you will get a debenture certificate when you invest money, and they will have some terms. Let's say you will get quarterly fixed payout. Every quarter you will get fixed payout of 12%. So NBFC generally raise from public is when they don't have banks funding them. The public is ready to fund them. When the bank is not funding, the interest rate goes up, right? So that's why I said 12%. So when the banks fund, maybe they are getting funded at roughly about 7-8%. When you go to public markets or the investors to get funding, the interest rate goes up, depending on multiple other factors also, like the rating of the NBFC and things like that. So we used to do, when I worked with an NBFC, we used to approach investors basically to raise money. So we used to sort of build a fixed income portfolio for the client, but obviously it is a concentrated portfolio. But these are the roles which NBFCs plays in a wealth management industry. So this is the middle layer. So these guys bring the products basically to the industry, and the front end layer sort of goes to the client or the customer. They face the customer and sort of basically give a glimpse of what the products are and sort of allocate their monies into these products. So I hope the front end layer and the middle layer is sort of cemented there in your mind. Now we'll just go down one more layer basically. This layer is the back end layer where the entire set of your operations work. So I'll give certain examples. So in fact, just go back to the front end and middle layer where I'll give some examples for your mind to get clear. So banks have given already example. So in private banks also you would have you have a lot of foreign players play in this space. Okay, like Barclays is a private banker. You have DBS is a private banker for a lot of clients. Citi was a big private banker for a lot of clients. Now Citi has been taken over by Axis. You would have listened to that news. Now, when you come to wealth advisors, the largest players in the industry, I would say Avengers. Avengers is a big player in this industry. ASK is a big player in the industry. Maybe you can note down these names because